Hello, we're going to show the output data from the B2T engine on the CAMT tax, or the Corporate Alternative Minimum Tax in the US. The tax is newly enacted by the Biden administration to apply a 15% minimum tax on the book income of high-profit corporations. For those applicable companies, CAMT is another way to calculate the income tax based on their financial statement income or the book income. The calculation involves its own set of book-to-tax adjustment rules and CFC integration rules to adjust the financial statement income. The prior net operating losses may be applied to reduce the income before the 15% tax rate is applied, and foreign taxes paid may be used to reduce the calculated minimum tax. The CAMT tax calculation logic is less than immediately obvious, but the B2T engine will handle all that automatically. The user only needs to map his accounts to the standard accounts and to tell the engine for which company that the CAMT tax is to be calculated. The results will be automatically included in the company's tax provision reports. Here, we're going to use a simple example to show the output data that are relevant to the CAMT tax. So here's our simple example. We have a US company P that is in an entity group, which is parent company. P is a parent company of the group, and it has a revenue of $1,000. So that's a simple one. Now we wanted to tell the B2T engine that we would like to calculate the CAMT tax for the company P. How do we do that? So we, at the entity record, we're going to enter a property to tell the B2T engine, because the B2T engine really does not have any user data, so it does not have things like average 3-year profit of the past and so on. So we must tell the B2T engine to calculate CAMT tax. So here's the property, and we're going to save it. And that's it. Now we're going to submit it to the B2T engine. We go to the recurring page and go to the top of it and click the submit button. The engine code start may take a few seconds. So now it's down. So let's open the output file. So here's the calculation result. We calculate taxes for the company P. Not surprisingly, $1,000, we have a tax expense of $210. So let's go to the details of that calculation. So let's take a look at the current tax expense for P. And we coming down over here, we have a taxable and multiplied by 21%, we have the regular tax. And here we see the CAMT tax is determined to be 0. In other words, there's no CAMT impacts on our calculation. Why is that? So we further go down to the CAMT calculation report. We can always search CAMT for that. And here is the calculation. So we have only one company. It has a pre-tax financial statement income, FSI. That's what the FSI stands for. And there's no adjustment. So the adjusted FSI is still 1,000. And that 1,000 is carried over to the taxpayer level CAMT calculation. There's no operating loss effect, so the taxable for the CAMT is still 1,000. At 15%, you have the TMT, or tentative minimum tax, at 150. And further coming down, we don't see any tax credits because we did not tell them any. So therefore, the TMT remains at 150. The regular tax, as we had shown earlier, is 210. So we have our regular tax, total regular tax, that's larger than the minimum tax. So therefore, there would be no CAMT effects. So that's why the CAMT for this case is 0. Now, this is relatively a trivial case because we don't have any detailed level accounts. So in order to show some of the detailed CAMT book to tax adjustment rules, we're going to add a few more interesting trial balances and to see how the B2T engine applies them. So we're going to close the output file, which is generated. Now we come back to the input file. Now we're going to add a few records for the company P that are more detailed trial balances. So here they are. First, we have an account of accrued income, which means the $500, we haven't really received the payments from the customers just yet. So we accrue into the balance sheet as an asset. And we have a pension expense, and we have foreign withholding tax expense to be considered. So we further has to tell the engine what those account types are by mapping them to the standard account types. So we go to the setup input, and in the account mapping, we enter a few records over here. So here they are. We have our accrued income, pension expense, and a foreign withholding tax expense. So that's it. We just added 3 more detailed level trial balances. And we're going to save it. And we're going to submit it again. So the calculation is down now. So let's go to take a look at the output file. Here we are. We go to the same provision sheet for the P. Now we see we start with 890 pre-tax book income for our regular current tax calculation because we had a 1,000 income and a 100 expense and 10 expense of the foreign tax withholding tax. So therefore, the pre-tax income is this. But there's a book tax adjustments added back. The end result is that we have the taxable income is 500 because the 500 accrued income, we haven't received them, so it is taken away from the book income. And we get our regular tax at $105. Now, more interesting is coming down over here. The regular tax is $105, and we have another tax expense as a special item here. That's CAMT at about $33. How does that number is coming from? So let's go down to the CAMT calculation report to take a look at the details. Here's our CAMT calculation for P. Now we start with a pre-tax financial statement income, and we have an adjustment on it to arrive at the adjusted financial statement income. Now, why exactly is that? Let's take a look at the further details to see the contribution of each of the detailed accounts that we just supplied in the input file. Now we see the US CAMT calculation at the account level. We see from the foreign withholding tax expense, it contributes to the foreign tax from a US company at $10. And from the book to tax adjustments, we see that the pension expense is being added back to the book income to arrive at the adjusted financial statement income. So these are the individual contributions, and we sum them up to have the total contribution at account level to the CAMT calculation. And these are the numbers that we saw earlier. So let's go back to that CAMT calculation for the single provision for our parent. So sum up all those adjustments, and foreign tax for CFC, there's none, but a foreign tax for US company, we have a foreign withholding tax. So we sum all that up. These are all the contributions from the account level data. And the adjusted financial statement income is a starting point for the taxpayer level calculation. We start with 990, and there's no net operating loss to use. So therefore, after net operating loss, we still have a 920. At 15%, we had the TMT, or tentative minimum tax, at 148. In our case here, we have paid foreign tax $10 by the USA company. It needs to be taken away from the TMT. So let's coming down further. Okay. So in the end, we finally arrived at $138 after the tax credit. So this is our TMT, tentative minimum tax. And the regular tax, as we calculated earlier, shown earlier, it is 105. Now we see, comparing the TMT and the total regular tax, we see the minimum tax is actually larger. So therefore, there's a shortfall. There is a CAMT tax expense to top up to the TMT. And the top up CAMT tax is $33 that the company has to pay. And the CAMT tax, once paid, can be carried over to reduce the future regular tax. So we also remember that carryover amount, $33. And so therefore we have the final journal entry to explicitly show the tax impact. Over here, we have the current impact as well as the future tax benefit. So as we have seen here, the user only supplied the trial balances and the mapping to the standard accounts. The B2T engine contains all the relevant CAMT rules and performs the calculation automatically for us. Now, another interesting thing about this calculation is that the engine also considered along the way a lot of CFC related items. But in our case, we don't really have a foreign subsidiary. So to make the example more interesting, we're going to assume that the parent has a foreign subsidiary. So we're going to close the output file and go back to the input file. Here's our input file. We go to the setup input to add another record for the subsidiary, because we now have another entity. So here it is. We have a child entity along with the parent entity, but we also have to tell the B2T engine that the P is actually the parent of CH1. So here it is. We are indicating that P is a parent of CH1 in this group, and it owns CH1 100%, both ownership share as well as voting share. And further, let's assume that CH1 had a revenue of $100, just to make things simple. So we go to the recurring input, and we are going to add one more record for CH1. So here's our new record. We indicate CH1 has a revenue account that has $100 revenue debit balance. So that's it. Let's save our newly updated input file and go to the top of the recurring input page to submit it into the engine to calculate that tax. So here it is down, and again, we're going to open the output file. Here we see the calculation now not only involves the parent, but also the child. And the child, we calculate for Canada because the subsidiary is foreign in Canada. And we also perform some calculation for USA as well as a shadow, as like reference data purposes, because it's the US government, the RIS, is looking at that Canadian subsidiary. So we go to the P sheet, the calculation for P provision. So now the current tax for P is still at $105 itself. It hasn't changed that much. Now let's take a look at a CAMT calculation. It is $33. Okay, let's see how exactly that amount is arrived. So as usual, we go down to the CAMT calculation report at the end. FDI, no, that's not. So here's a CAMT. So the calculation for P is the same. It has all those adjustments that we had shown earlier. Now here we have the calculation for CH1. It contributes to the pre-tax financial statement income by $100 because it has $100 revenue. And also, the CH1 is paying Canada tax $15 because Canadian tax rate is 15%. So it has $15 foreign tax by the CFC. So it's over here. At the taxpayer level, the calculation process is the same as usual. So we start with the adjusted financial statement income. AFSI is 1090. We still don't have the net operating loss deduction. So the AFSI is still 1090. At a 15%, we would be getting the TMT at $163. Okay. Now, this $163 is further being reduced by the FTC or foreign tax credit because its USA company is paying $10 through the foreign withholding tax that we showed earlier, 10 over here. And further, the CFC has $15. Okay, the CFC paid the foreign tax $15. It can be used as foreign tax credit to reduce the TMT. Okay, so 25 total FTC reduce the 163 to 138. So that's our TMT. And separately, our regular tax is still 105. Let's further go down. Comparing the two, we see our TMT is larger than the regular tax paid. So therefore, we have a shortfall that the PE has to top up with this CAMT tax expense. And again, as before, the amount paid is being carried forward to reduce future regular tax. So, and we have the CAMT journal entry. Here again, the engine has the relevant CFC rules for CAMT calculation and apply them automatically. Users do not need to enter any of the such rules. So to summarize, the user only needs to input his business data, such as the entity structure, the trial balances, and the mappings to the standard account types. The B2T engine has all the relevant CAMT rules, and it will automatically perform the CAMT calculation. That's it. Thanks for watching.